everyone. Welcome to joining for our Andersen Tax 101 webinar today. Today's budget, we are going to cover the Canadian budget, which was announced last Wednesday. Today, it will be presented by me, Philip, and also Kenneth Patingo from our Ontario office. So first, before the webinar start, we're going to talk about some of the housekeeping items. So in case you have any questions, feel free to ask the question in our chat box. There were two panelists sitting during the webinar, going to keep track of the question. They might answer it during the webinar. Some of the question may be brought towards the end of the webinar, will be answered by us. And also, once the webinar has been finished, you will receive a short survey about your feedback about this webinar and any future topic that you're interested in. Also, you could turn on the live transcript function of Zoom to have the closed captioning. Today's agenda, we're going to cover some of the items that was announced on last week's federal budget. That includes the alternative minimum tax, intergenerational business transfers, the general anti-avoidance rules, some international tax measure, and clean energy credit, and some other mentionable items. So first, Kenneth will just discuss the alternative minimum tax change for us.
Good morning, everyone. So let's take a look at what has been changed based on the proposed budget. So on the current legislation, the calculation for the alternative minimum tax is actually very straightforward. But because of the proposed budget changes, they changed they actually broadened the base of calculating the alternative minimum tax. First is they have the capital gains inclusion rate increased from 80 to 100%. They have the 30% of the lifetime capital gains exemption included in the calculation, which has actually been included in the current legislation. They have included the 30% of the capital gains on donated shares of publicly listed corporations. They have also included 100% of the employee stock option benefits. But there are some actually disallowances when it comes to certain expenses, which is they reduce it by 50%. So I'm going to give one of the example is, let's say if you are an individual and you have employment expenses that the calculation before was 100% deductible. Now, based on the AMT new calculation, you can only have 50% deductible. Another thing is they have the 50% of non-refundable tax credits that usually part of the calculation. Before it was 100%, now you can only avail of 50%.
Yeah, so one of the comment I want to give is for the audience that is not familiar with alternative minimum taxes, this is essentially a different way of calculating your tax. As the name suggested, that's the minimum tax a taxpayer is subject to. It was following a different rule of calculation, and whatever the minimum tax was compared to the normal tax obligation. In the case that the minimum tax is higher, then you would be subject to additional AMT tax that is payable. So what kind of cover is basically the difference when you're calculating the tax payable under the alternative minimum tax regime comparing to the regular tax. So that's all the items that have to be changed. So as part of the federal budget, there's also other change to the AMT.
Okay, so the additional changes were before, or actually the current legislation, we only have 15%. Now they're trying to increase it to 20.5%. So actually, when you try to calculate the AMT, so whatever the tax is payable based on your tax, and you compare it to the adjusted taxable income, which is taxed at 15% currently, now they're gonna have it as 20.5% tax, and whichever is higher, you will be taxed at 20.5%. The other difference is in the current legislation, the exemption amount was only 40,000. Now, on the proposed budget, they're trying to increase it to 173,000. And this alternative minimum tax is applicable after 2023 year end. So, for example, we have calculated the alternative minimum tax and the taxes owing based on your regular income. So whatever difference on those amount will be carried forward for 7 years. So, but here's another problem in case, for example, I will just give a real life scenario situation. For example, you are an individual, you hold a shares of a qualified small business corporation. Now, you sold those shares, and those shares can avail for a lifetime capital gains exemption. So usually, you are paying lower tax when you try to calculate it using your regular taxable income or based on your marginal rate. But the only thing is, when you try to calculate using the alternative minimum tax, the tax is much higher. So the difference between the two, you could use it moving forward. But here's another issue. What if moving forward, you don't have any sources of income? So you only have 7 years to use up all those tax credit. And there's a possibility that, for example, a retired person doesn't have any sources of income moving forward, they may lose the AMT tax credit.
So yeah, as Kenneth mentioned, there could be potentially a additional tax burden for certain type of taxpayer. I think there was obviously some other planning opportunity available to avoid the tax burden, including maybe you want to accelerate the business sale to be in tax year 2023. Or in the case that if you are actually subject to AMT tax, try to make sure that you have the plan to realize enough income that is not going to be subject to any adjustment for AMT purpose to try to utilize some of the AMT that is previously payable within the 7-year carry forward windows. So that's definitely something new for this budget. And another big change that announced through the budget is intergenerational business transfer. To give you guys a little bit of background is in the Income Tax Act 84.1, there was a series of act that basically try to recategorize some of the capital gain as dividend when the business sale was to a non-arm's length party, anyone that's related to you, when you're just selling your business to a related family, and after the sales, the subject corporation is connected with the purchase corporation, then Tax Act 84.1 would just kick in and recategorize all the capital gain into dividend. Also, they're going to going to increase the amount of dividend to include something we refer it to soft adjusted cost base. Usually, it's going to create it by crystallizing the shares utilizing the lifetime capital gain exemption. The tax policy's perspective is trying to make sure that the taxpayer cannot use a non-arm's length transaction to extract capital on a tax-free basis or a tax-preferred way of the capital gain. So that create a couple results for that. The 84.1 is it limits genuine intergenerational business transfer when the business is subject to succession. Maybe the parents sell the business to the kids for continuing operation. The parent would realize capital gain, realize dividend instead of capital gain, which is taxed typically at a higher tax rate. And also because now the parents are realizing a dividend, they would not be qualified for the lifetime capital gain exemption. So that's two of the unwanted result related to the 84.1. And then the government realized that it basically limits a lot of ability for intergenerational business transfer. Then they introduced the BC 208 in part of the federal budget in 2021 to provide certain exceptions in the case of a non-arm's length transaction of a qualified small business corporation or some certain family farm and fishing corporations. They also introduced other conditions with it that have to be met for the 84.1 to be not applicable. And then for this year's budget, they announced additional modifications to the existing rules. They've removed certain rules and then introduced new conditions. And also they introduced two separate type of transfers, the immediate transfer and the gradual transfer. They have slightly different condition to be met for 84.1 to be not applicable. So now let's walk through some of the condition that has been removed as part of the new budget. So previously, there was a requirement for the purchaser to not dispose any of the shares of the subject corporation within 60 months. That condition has been removed. And they also removed the condition about the limit on the taxable capital employed in Canada of $10 million. And they removed the requirement of independent assessment of the shares and the affidavit that is signed by the vendor and a third party attested the disposal of those shares. Those conditions are basically removed as part of the new budget. And at the same time, they keep certain condition that is not changed. So at the transfer date, that the corporation still have to be a qualified small business corporation, a QSBC, or a shares of a family farm or fishing corporations. That remains the same. And the purchaser corporation have to be controlled by one or more descendant of the transferor. The descendant include both direct and indirect descendants. In this case, it would be used, commonly refers to just the children, the grandchildren, children-in-law, nephew and nieces. So those conditions mostly remain unchanged. And then we're going to talk about some of the new conditions that introduced for the different transfers. So for the immediate transfer, is rather mostly referred as a 3-year test. So the condition could be categorized into a broad 5 categories, including the transfer of control of the corporations, transfer of the economic interest in the business, and transfer of the management of the business. And then the child have to retain control of the business, and then the child works in the business. Most of the tasks would have to be finished either at the point of transfer or within the 36-month period. One of the key factor here is the control have to be both legal and factual control have to be transferred at the time of control, at the time of transfer. You can see that in the later slide that in terms of gradual transfer, there is slightly different requirements. And in terms of economic interest in the business, it's mostly referred to the common shares, which takes mostly of the economic growth, the value growth of the corporation. That has to be, majority of it has to be to transfer to the children at disposition, which means that the vendor, the parents in this case, could not own more than 50% or more of the common shares. And then the remaining share have to be transferred to the kids within the 36-month period. So you have 3 years to transfer everything. The business management have to be transferred within a reasonable time. So they assure that the parent have a certain reasonable time frame to transfer the business management. It doesn't have to be happen right away when the transfer happens. And after that transfer, the child will have to retain the control for at least 36 months. And also one or more children have to be actively involved in the business for at least 36 months. So assuming that the transfer meets all this criteria, then the children and the parent would file the election jointly for 84.1 to be not applicable. Then the parent would get the tax implication of the disposition of the corporation will be treated as a capital gain purpose, and then they would qualify for lifetime capital gain exemptions. So this is some of the condition with immediate transfer. And then the gradual transfer, they expanded the time frame for certain tasks to the 5 to 10 years periods. There was also some minor difference between the different conditions for different areas. So first, at the moment of transfer, only the legal control have to be transferred to the children. The factual control could be retained by the parents in this case. And also the second one, the common shares, again, it have to be, majority of it have to be transferred at disposition and the remaining balance at 36 months. However, there was additional requirement for the debt and equities that which have to be happen within 10 years of the sales. So depending on the type of a corporation we are discussing. So for a farm and fishing corporation, the parent's debt and equity have to be reduced by 50%. So debt and equity typically including shareholder loans or non-participating preferred share that is non-voting, because the parent could not own any voting shares because of the control have to be transferred to the children, or 30% in the case of a small business corporations. So there was, though that is one of the difference between immediate transfer and gradual transfer. And the rest of the conditions are similar to the immediate transfer, except that the children have to retain control of 60 months instead of the 36 months that we have mentioned earlier for immediate transfer, or up to the completion of the business transfer. So you can see that the gradual transfer typically have a longer time frame for all the tasks to be met, with some additional tasks that have to be met, mostly referred to the reduction of the parents' debt and equity in the business. So giving the more clear guidance on what kind of transfer between the intergenerational business is qualified for the exemption of 84.1, there was a lot of planning opportunity that is available for our clients and taxpayer that could utilize to make sure that the transfer is not subject to 84.1 and get the more preferential tax treatments. You just have to, I think the taxpayer have to decide which transfer they're going to use and then understand the pros and cons about it. For immediate transfer, the one key thing is at the moment of transfer, both the legal and factual control have to be transferred right away. And then all the tasks have to be met within the 36-month period. But it kind of ignores the requirement of reducing the debt and equity ratios, which the gradual transfer would require. So I think the taxpayer have to factor in the actual business plan and then see which would be the better option for them to choose. So the next, we're going to cover the general anti-avoidance rules. So Kenneth, can you talk more in details?
So with regards to the general anti-avoidance rule, generally tax avoidance is legitimate, but the question is, are you abusing the tax avoidance based on using the Income Tax Act or a section of the act, or actually the whole income tax? So what happened was on the budget right now, they have added a preamble with regards to GAR, or General Anti-Avoidance Rule. So the new thing about the budget is, for example, you made a tax strategy and you're expecting actually a tax benefit out of it. So because of this preamble, it says it will apply regardless if the tax benefit was foreseen. Another changes is before, or the current legislation of the anti-avoidance rule is, we look into the primary purpose of the transaction. And because of the proposed budget, they switch into the change to one of the main purposes from primary purpose. They just try to narrow it down, the kind of transactions that the for the tax strategy that you're going to pursue, because they want to capture if that transaction is being subject to GAR. And the main thing actually with regards to the budget is the economic substance test that was introduced. So the economic substance test is when you do a transaction that will actually be subject to GAR, you need to take a look if the transaction has an economic substance or it's lacking an economic substance. So when we say lacking economic substance, we're just only making the transaction to avoid the taxes. So here's one of the example that actually that has been pointed out on the budget by the CRA. First is, let's say you have an investment in a non-registered account. So all of the income is going to be taxable for you personally. Now you wanted to transfer it to a TFSA. So when you transfer to a TFSA, so most of the money in there are already after tax money. So because on your non-registered account, you dispose all those shares, you pay taxes on it, and you get the cash. Now you put the cash inside the TFSA based on your TFSA room limit, and now those cash were reinvested inside the TFSA depending on what kind of securities it was. So all of the income will be under TFSA will be all tax-free. But the only thing is you are following what are the rules or what the legislation says. So this is not this is a tax avoidance, but it's not subject to GAR because you are following what's the legislative intent of the TFSA program. But when you transfer actually those funds coming from your regular non-registered account going to your TFSA, there was no economic substance. It was just purely tax avoidance, but you are within the bounds of the law and the legislative intent of using the TFSA, so this is not subject to GAR. So for example, CRA found out that the transaction that you pursued are subject to GAR, there will be a 25% penalty on the tax benefit. So how can we avoid this 25% tax benefit? So we try to remember what happened in the budget of 2022. They have actually a proposal regarding the mandatory disclosure or the proposed reportable transaction. So as long as when you try to do a transaction and you inform CRA through the mandatory disclosure rules or proposed reportable transaction, you can avoid this 25 penalty on the tax benefit. Another thing is what's new about this GAR is they extended the reassessment period by 3 years. So if you are a Canadian-controlled private corporation, the normal assessment period is only 3 years. And if you're a non-Canadian controlled private corporation, the assessment period is 4 years. So now because of this new rule, if you're going to be subject to GAR, for a CCPC, you're extended by another 3 years, which makes it 6 years. And for a non-CCPC, you're going to be extended by another 3 years, which makes it 7 years. So actually this GAR is only proposed on the budget and still open for consultation until May 31st, 2023.
So Kenneth, it appears that the government tried to basically widen the application of the GAR. Now they actually expand a lot of the tests that was written a little bit differently previously. Now they try to introduce a lot more of the intentions, and they want to change it, and they also imposing a penalty. So for any taxpayer want to get into any advanced tax planning strategy, they have to really gone through the question on whether it's worth it, because now it could potentially captured by GAR. And does it make sense to disclose all those planning to avoid the penalty? Does it attract the additional or unnecessary attention from CRA? I think that it actually brings out a lot of more question than answers. So that's part of it. It's still a developing story, like Kenneth have mentioned. It's still open for public consultation. The final wording of the preamble or everything is not finalized yet. We would keep an eye open on the newest developments. And then Kenneth would also help us to cover the international tax changes.
So on the proposed budget, we have this new international tax reform. So what happened was, under the OECD, they have come up with the two pillars when it comes to international tax reform. The first pillar is the reallocation of taxing right. So what do we mean about reallocation of taxing rights? We're taxing profits of the largest and most profitable multinational enterprises to countries where users and customers are located. So these are not imposed yet at this moment because we still have this digital service tax, which will be effective on January 1st, 2024. So if the digital service tax will come into effect, so the reallocation of taxing right is still pending as of the moment. So if the reallocation of taxing rights comes into force, the digital tax service will be pending. The another pillar for the international tax reform was the pillar 2, when it comes to the global minimum tax. So for this pillar, the multinational enterprises are subject to at least 15% of tax, regardless where the income is earned. But here's one of the conditions. The annual revenue should be greater than 750 million euros, which we can convert it to Canadian dollars. It's going to be approximately $1.1 billion Canadian.
Yeah, this is a developing story. I think that's similar to a lot of countries on the world that they are trying to impose the global minimum tax without providing a lot of the details on how exactly the rule will apply. We will still keep an eye on it when the rules is more clear. The next one is the government also includes a series of credit for green energy related. It's mostly investment for the manufacturing of different equipment that is deemed to be related to green energy, including carbon capturing, hydrogens, clean technology manufacturing, geothermal energy, zero emission technology manufacturers. The credit offer is depending on the equipment and the criteria, it could be valid, and also depending on the year that it was put in service, the credit amount could be different. We are not going to cover all the details related to all those green energy credits. If you have a business that is in any of these areas, likely you're going to get some benefit from the government. So the last part, we are going to cover some other items that is worth mentioning. So I would want to touch base on the flow-through shares. Is nowadays the budget allows certain development exploration expense that could be directly flow to the shareholders of those shares. It provides tax benefit for the investment in those flow-through shares. And then they also introduce tax on repurchase of equity. So one of the background for that is during the economic downturn, some of the larger organizations that is publicly traded, instead of invest money into expanding the operations, they use that to repurchase the shareholders' equity. So the government is going to impose a 2% tax on any equity that is repurchased for any publicly traded shares. The next change is the retirement compensation arrangement. They fix some of the condition for the stranded remittance. The retirement compensation arrangement usually is beneficial for any high executive of a corporation that is coming from a foreign country, or any professional athlete that is coming from from another country, that they have the employment in Canada, but they are going to depart Canada after the retirement or when their terms is ended. So the arrangement was set up between the employer and the employee directly. Then they contributed the actuarial amount of retirement benefit to the plan. There was a lot of complicated mechanism to make sure that the employer would be fulfilling those obligations. They just changed, this proposed basically just updated some of the condition for the remittance. The next one is the removal of the dividend received deduction. So previously, for any corporation that receive a dividend from another corporation in Canada, it's allowed a deduction equal to the dividend amount. to make sure that the dividend is not going to be taxed again until it was distributed to an individual shareholder. Under the new federal budget, this deduction is going to remove for financial institute that has security subject to the mark-to-market. So if you're invested into any larger mutual fund that receiving a lot of dividend from the same country, likely you would expect the distribution amount from those funds would be smaller because now the fund would be subject to tax on those dividend received.
So in addition to the other items that we're going to talk about with regards to the budget is about the grocery rebate. It's not actually about the groceries. It's actually a relief for the GST by paying GST to all those low-income individuals across Canada. So the GST credit right now, based on what you have, based on the individuals receiving, let's say January of 2023, a family who is receiving a GST rebate of $77, because of this new proposed rebate, they're going to increase it by the same amount, which is going to be doubled, which is going to be $153. So for an individual, a single individual actually, you're receiving a $40 in January. They're going to double it to become $80. And for an individual who has a dependent, they're going to double it from $41. It's going to be $80. So, but the only thing about this GST rebate is this is income tested. So if you have a family income of approximately $40,000, which is coming from your 2021 income, so when you exceed that amount, it's going to grind the credit. It's also true with a single individual who has an income of approximately $10,000 coming from your 2021 income. So the excess of $10,000, it will grind down your GST credit. Another thing new about the budget is the Registered Disability Savings Plan. This plan is supposed to expire on December 31st, 2023, which is almost at the end of this year. Whoever can apply for this disability savings plan is your qualifying family member, which is usually your parent, your spouse, or your common law partner. With the new budget, they're gonna extend it by another 3 years, which will expire now on December 31st, 2026. And they have also expanded the definition of the qualifying family member. It now includes the sister or brothers of the beneficiary. And the last item, which has been tackled on the budget, is also the Registered Education Savings Plan. So let's say, for example, if you are a student and your parent has been contributing to this plan since you were a kid, and now you went to university and you are in school full-time, the current legislation, you're only allowed to withdraw $5,000. But because of the new budget proposal, they're going to increase the withdrawal of the student to $8,000. So if you're a student that you are in a part-time going to school, on the current legislation, you are only allowed to withdraw $2,500. But because of the proposed budget, they're going to increase the draw from $2,500 to $4,000. And before, whoever set up the RESP is only, for the kid, is only the parents who are the spouse. But now they have expanded whoever can open the RESP for the student. For example, before you were married and now probably later of the year, you got divorced or separated. So you can, those individuals who got separated can still make a contribution to the RESP as long as they make a joint election in order to contribute for the RESP. So that's are the new things about the registered disability savings plan and registered education savings plan.
Thank you, Kenneth. So this is all the material we are covering today. So like I said previously, you're going to receive a survey from us about how we can improve and other topic that you would like us to cover in the future. So now we will stay here for any question that you might have.
Yes, Philip and Kenneth, we have two questions related to AMT, or alternative minimum tax. So the first one is, with the new AMT rule, do you think it's still recommended to do the flow through shares?
Yeah, I think that's any kind of this type of question have to be reviewed at the overall tax situations. If the taxpayer is interested in invested in flow through shares, I think we will have to do a certain tax modeling to get the idea about the tax exposure related to those flow through shares. And then if there was any chance that the AMT would be payable, it's likely going to get larger, the balance for this year after the new proposal, after the new budget. And that whenever the taxpayer is deciding whether to invest in those flow through share, we have to look beyond the original AMT payable as well to see whether there will be enough regular tax payable within the next 7 years to potentially recoup that AMT payable. If that's the case, then that's still going to be a valid investment vehicle for the taxpayers. To summarize, basically, we have to look at the overall pictures. It might still make sense, even though that now the AMT tax rate is higher.
That's great. And the second one, again related to AMT, and specifically regarding dividends paid by pipeline companies. Do we think that the AMT could effectively kill the dividend that pipeline companies provide, i.e. dividends that are taxed as capital under capital gains tax rate?
So I think I would give a similar opinion about whether it would kill it or not. I think different taxpayer, depending on your income level, what other type of income you have, it might be, you might come up with a different investment decision based on the AMT implications. There was no clear answer saying, yes, they would work or they don't, it depending on all the other type of income. I think since the AMT rule has changed, now is a good time to review your income situation and do some modeling about getting a clear idea about your AMT exposure. And then if there is any way to utilize those AMT payable within 7 years, if no, then we would have to come up with different strategy, either limiting those income that is subject to the AMT adjustment, or maybe even increase other income to make sure your normal tax is higher. So there was always some planning to be done. It's a good time to do it right after the budget has been announced. So you could just take a review, take any action between now and the end of the year, because the AMT new would be applicable for the tax year of 2024. So there was still some time to take any action.
Great suggestion, Philip. So those are all the questions we received from the floor.
Okay, yeah. Again, thank you everyone for attending. We look forward for you to attending again for our future webinars.